Well, the U.S. economy is in terrible shape right now. It's only going to get a lot worse. You know, Time magazine ran a headline a couple of weeks ago where they labeled the decade that just ended the decade from hell. They were wrong. That was a decade from sin. This is the decade from hell. Because now we're going to have to pay for all those sins, right? Last decade is when we borrowed all this money, we printed all this money, when we had the housing bubble, we had all this reckless spending. We're going to have to pay for it. The problem is we're still committing the sins, right? We still have interest rates that are too low. We're going deeper into debt. We're not allowing the economy to work.
Well, it's the crash of 2010, as we had forecast at the beginning of this year. And what's happening is the stimulus money is running out worldwide, and any time that there's a trigger like Greece or something else, the market is going to decline. As you well pointed out, we know it's a rigged game. How it was rigged and who rigged it, well, that will never really get to the bottom of it. We never know the truth of those things. But I do believe that the market is unraveling, and what they did do yesterday is they came into and pulled out all the stops to jack it back up from not crashing. And they're going to do it for a number of days, and they're doing it globally. There's no stopping the meltdown. The markets collapsed, Alex, in March of 2009. What they did was they pumped them up with all of the stimulus money. It's as simple as that. It's all of Europe, the United States, the UK, India, China with its free lending policies and stimulus, Japan, South Korea. It's worldwide. Now it's running out. Just as we're seeing these phony unemployment numbers coming out, they're only juiced up by the stimulus money. When the stimulus runs out, the markets crash. The markets are now crashing now. So here's the game.
We are in the midst of recovering from recession, and tax receipts, both in terms of
hold
rate.
on 1 second. We just want to alert our viewers. Of course, they can see it on the screen. The Dow is losing about 653 points at this very moment. A very huge swing today. At one point, we were to the plus side. Of course, the riots have calmed down in Greece, but the markets are having sort of a whiptail effect that is really negative for anybody who is bullish at the moment. Although we could argue, Neil Hennessy, that there are ways to make money at the moment. I'm looking at the ticker symbol D as in dog RR, which is the market vector's double short the euro. It's up 3 3/4 points, and now Dow is down 707 points. You could argue things are on sale at the moment. This is a riot of I don't want to say only 150 people of that crowd, and it seems to be calmed down, but the markets are not buying it. So what does an investor do? Sit tight or move?
Well, the first thing you have to do is calm down, just sit back and look. The market started to take the slide last Friday.
We do have some problems, of course, jobs chief among them, but look at this market. It continues to slide. Jim, it is now minus 868 right now. The Dow is heading to 900 to the downside. By the way, we shouldn't forget, it's below 10,000 now. It seems we have a 4-digit market now after having a 5-digit market for a long time. Jim, we should mention also that oil is also taking it on the chin. It's down about 6% right now. So it's down 900. Again, I don't mean to sound like a broken record here, but this thing just continues to break records.
Yes, when we began this hour, the Dow was down about 200 points. So we have seen quite a move to the downside. And if you just happen to be tuning in, what had happened was there was a pretty intense Greek protest just outside of the parliament, and the police very effectively dealt with it, but the market is very nervous at this point. You look at gold, it's up $26 now, above the 1,200 mark at 1,200. Crude oil plummeting by now about 6 1/3%. Earlier it was down 3%, and the dollar is surging against the euro, which is now at about a 14-15 month low.
And we are close to an 1,000-point decline. Donna, what do you make of it?
Bob Dahl of BlackRock met with him last night. He was talking about how the...
the insider trading starts happening. The big guys start pulling it out because they know what's coming next. They jack it back up, and then they get the shills out there to say, listen, this is a good buying opportunity. The market is only going through a correction. We have a lot of fundamental strength in the economy, and they sucker the people back in. So anyone that thinks that this is going to be a market that's going to grow in strength deserves what they get.
All right, Charlie.
We just had a great PMI number. We've had housing numbers that, in terms of the housing indices, that we're up off of, we're on multi-month highs. We're seeing labor, we're seeing jobs payments. We're maybe getting a positive in December. It's all relative, but I mean, worse than what?
Housing prices are still too high. The only reason they're not falling, which would be a good thing, is because the government is artificially propping them up. You have 0% interest rates, you have tax credits, you've got the Federal Reserve buying up mortgage paper, you've got 96% of the mortgages being guaranteed by the federal government. That is not a good thing. This is a huge problem.
It's a Band-Aid. I mean, and it's about a stimulus to extend this. I mean, housing, whether it's too expensive or not, you're seeing the economy recover.
No, you're not seeing the economy recover.
You are.
What we're doing is we're going deeper into debt and we're spending money, but beneath the surface, the economy is not recovering. The economy is getting sicker. And that's why at the end of the year, you're going to see unemployment higher than it is today. You're going to see interest rates higher than they are today. And you're going to see inflation higher than it is today.
At the end of the day, meaning by the end of 2010?
The end of the decade, yeah, the end of the year.
The end of the year, okay.